Deputy Murphy. Deputy Tommy Broughan. 20 minutes.
Thanks, Cahirla. Well, Budget 2020, of course, it needed to be a dynamic, proactive budget to protect the incomes of our people facing the challenges of Brexit and the climate change actions. In the event, of course, 2 weeks ago, the budget was a regressive imposition on huge cohorts of Irish society, effectively cutting the real incomes of families and citizens in social protection and those in lower-paid jobs. And despite the concerns repeatedly expressed by the Irish Fiscal Advisory Council and civil society agencies like Social Justice Ireland, and the regressive, of course, increase in carbon tax, there was no attempt to widen the tax base and lessen Ireland's serious tax dependence on the corporation tax being paid by a small number of multinational companies, as Deputy McGrath said earlier, 45% from just 10 companies. So despite much good work being done by the Department of Finance in the tax strategy group papers, which we thank the Department for, there was also no effort whatsoever in Budget 2020 to address the huge cost of tax expenditures to the Irish Exchequer, accepting the Minister's efforts to address the very serious and growing risk from the hard Brexit, which has now been approved in principle by the UK House of Commons. Budget 2020, of course, was largely a non-event. The Finance Bill 2019 before us is a fairly similar exercise, which, despite a number of major insertions into the tax code, does nothing to ease the tax burden on lower-income citizens and families, or address the medium and longer-term sustainability of corporation tax and the ongoing large annual leakage from national revenue through tax expenditures. Nearly a third of the bill, of course, concerns a new Part 35A of the Principal Act to reform the provisions on transfer pricing in Section 26 and a new Part 35C to implement the EU Directive 2016/1164 of 2016 as regards hybrid mismatches in Section 30. Transfer pricing, of course, refers to aspects of inter-company pricing arrangements between related business entities and includes inter-company tangible and intangible property transfers and finance transfers. And the changes, of course, on transfer pricing are being introduced to bring our tax legislation into line with the 2017 OECD transfer pricing guidelines, and this new Part 35A of the Principal Act, of course, will apply from January 1st, 2020. I understand that currently Irish transfer pricing rules apply to trading transactions which are chargeable to tax under Schedule D Class 1 or Class 2 of the Consolidation Act 1997, and the new rules, of course, do respond to reforms, and that's welcome, in the Coffey review of the Irish Corporation Tax Code, and as I said, they're welcome for that. The new section on transfer pricing also follows on from our Departments of Finance's the feedback statement following the earlier public consultation. Of course, the OECD 2017 transfer pricing guidelines in Section 26 replaced the existing 2010 guidelines. The new section, of course, extends the transfer pricing rules to cover cross-border non-trading transactions. It removes the pre-July 2010 exemption for grandfathered arrangements and extends the rules for national capital transactions. And, of course, the new rules hopefully will bring less bureaucratic transfer pricing documentation to SMEs. But it has to be asked here, what real impact will this modernisation of transfer pricing rules have on increasing tax flows to the Exchequer? For example, is it expected that companies will utilise further tax avoidance measures around transfer pricing? And other deputies, of course, I said that earlier this evening, that it's like a cat-and-mouse struggle the whole time with some of these companies. I know, for example, that the Budget 2020 Tax Policy Changes reports, which is published by the Minister's Department with Budget 2020, it gives a yield of only €10 million in a full year from both the transfer pricing and the anti-hybrid rules changes, which is a very small sum in the context of the massive flows of money in these companies. The new 11-chapter amendment, of course, in Section 30 is inserted into the Principal Act after Part 35B. That concerns hybrid mismatches and also further implements EU Directive 2016/1164 of July 2016. This directive, of course, is the EU Anti-Tax Avoidance Directive, ATAD, and the aims of the new anti-hybrid rules, of course, is to prevent arrangements which exploit differences in the tax treatment of a financial instrument or entity under the tax codes of two or more jurisdictions to produce a tax advantage in the so-called hybrid arrangement. And associated enterprises, of course, are defined as holding a certain percentage, 25% or 50% of the shares, voting rights or rights to profit in another entity, or if there is another company that holds that percentage in both entities. And companies, of course, included in the same consolidated financial statement, or where one entity has significant influence on the management of another, will also be considered associated companies under the new Part 35C of the Principal Act. The new Chapter 7, 8 and 9 of this part on tax residency residency mismatches, on imported mismatch outcomes and on so-called structured arrangements, they do seem valuable innovations into the Irish tax code, and of course we'll get a chance, I suppose, to discuss them further at committee stage. But can the Minister confirm, or the Senior Minister, that all the specific situations which are set out in the EU Anti-Tax Avoidance Directive in ATAD, and they go through very specific situations in the ATAD, are they all now covered in this new Part 35C? I mean, the new rules apply especially, Cathaoirleach, in fund and financing structures when companies make payments that give rise to a tax deduction in Ireland, but no other country taxes the associated receipt by reason of hybridity. But the types of mismatch outcomes which may arise seem very complex and difficult for revenue to police when they come into effect after January 1st next year, given that hybrid financial instruments are broadly those which are treated as debt in one jurisdiction but as equity in another, and the hybrid entity, of course, is often seen as opaque in one jurisdiction, very often in our jurisdiction, but transparent in another. Last year, Cathaoirleach, the Parliamentary Budget Office produced an interesting briefing on tax expenditures in Ireland, briefing paper 13 of 2018. This was in response to requests from myself and many other members, Deputy Boyd Barrett and others, on the Oireachtas Budget Oversight Committee for much more information and consideration of the massive cost of tax expenditures. Indeed, I raised this very issue with the Taoiseach on Leaders' Questions shortly after, I think the first time I did Leaders' Questions with him, Cathaoirleach, after he took office. Parliamentary Budget Office, of course, called for a definitive list of benchmark measures and tax expenditures which are in effect in Ireland. The PBO also asked for alternative measures of estimating the cost of tax expenditures, given the underlying inherent weaknesses in the standard revenue forgone method, which the Department, I think, is still using. The final revenue forgone methodology, incorporating behavioural effects and the introduction of different policy measures, was advocated rightly, I think, by the PBO, which also asked that the data provided by the Revenue Commissioners and the data of the Department of Finance should be consolidated, notwithstanding GDPR and privacy considerations, in respect of the cost of tax expenditures. So while there has been some improvement, Cathaoirleach, in the review process for tax expenditures by the Department of Finance, the PBO and the Budget Oversight Committee, of which I am a member, we have also called for systematic ex-ante reviews of all tax expenditures to assess their appropriateness and planned implementation. But there is no such detailed ex-ante evaluation for changes in this finance bill beyond the cursory estimates in the Budget 2020 tax policy changes. So we don't know what a lot of these measures are going to cost or what kind of revenue they are going to bring in. In relation to BEPS implementation of corporation tax, of course, that document estimates, as I have said before, the anti-hybrid rules changes and the reforms of transfer pricing together as just being worth an additional €12 million to the Exchequer. A key criticism in the PBO report, of course, on tax expenditures is that once enacted, tax expenditures are not subject to regular parliamentary debates and scrutiny, unlike directly voted expenditure, where again and again we could keep coming back to areas like health and housing. But the cost, of course, of tax expenditures is massive, Cathaoirleach. The PBO estimated the cost at €4 to €5 billion per annum in 2014-2015 and over €5 billion by 2016. The R&D tax credit alone was costed in 2016 at €670 million. That's, I think, the last review. CAT agricultural relief cost €141 million in 2017, and film industry relief cost €88 million in 2015. And in the same year, relief supporting business cost €559 million, and the cost of tax expenditures relating to share-based remuneration cost almost €74 million in 2016. These are huge expenditures by this state, given a situation where my colleague, Deputy Connolly, yesterday drew attention to an elderly woman waiting for 5 hours on a trolley and ending up on the ground in great distress for many hours. I mean, these are incredible expenditures in the context of what's wrong with health and what's wrong with housing. So while this finance bill anticipates some of the serious difficulties for business as we face into some type of Brexit, and it looks like the Brexit on the British, on the side of England, Scotland and Wales is going to be a really hard Brexit, Cathaoirleach. The cost of benefit in kind, Section 5, SARP, Section 8, KEEP, Section 10, the Living City Initiative, Section 17, Distribution, Section 22, these are all sections of the bill in front of us, and Scientific and Certain Other Research, Section 24, they must be closely invigilated. And the Budget 2020 Tax Policy Change Report estimates the cost of all of these more or less together as being €80 million in total in a full year. But, Minister, where's the breakdown? Where's the breakdown on these tax expenditures, on the exact cost of these reliefs being rolled over into 2019? And some of them aren't they? The SARP has been, and my colleagues, Deputy Murphy, just spoken about that, a very unfair expenditure. SARP has been rolled over to December 2022, but hopefully we should have a new government by then. Yet when one examines, of course, the impact of direct taxes, such as the increase in carbon tax from €20 to €25 a tonne of CO2 emitted in Section 44, the Department of Finance is then able to come up with a very precise figure of 130 million in a full year, and likewise the introduction of NOx, nitrogen dioxide charge, in Section 49 of this bill is estimated to cost to bring in 25 million in a full year. The Irish financial crash under the austerity governments, of course, spawned our current desperate homelessness and housing crisis. And the arrival of the vulture property companies, welcomed here, of course, by former Minister of Finance Michael Noonan, who told us that vultures perform an essential task in the ecosystem by picking the carcass clean. Except in this case, the carcass was vulnerable Irish citizens and Irish households. The Department of Finance prepared a valuable briefing on real estate investment funds, Irish real estate funds and Section 110 companies in July 2019 as part of the Tax Strategy Group papers. And again, I think deputies are grateful for all the work the Department has done in this regard, which has helped to inform us when we approach this bill, and the work of the Budget Oversight Committee, and I think the Finance Committee as well. And of course it explained about the evolution of rights of quoted companies and collective investment vehicles to hold rental properties, starting in the States, I think in the 1960s, now spreading to over 35 countries, I think something like 14 EU countries except ourselves, and of course based on the principle that only the distributions are taxed. And of course the Kenny-Gilmore government introduced a very pliable tax regime for these vehicles in the 2013 in the previous Finance Act of 2013. That's Part 25A of the Tax Consolidation Act 1997. And Section 23, of course, of the 2016 Finance Bill introduced a new tax regime for funds that hold IRF assets. Of course, during 2016 also, we had issues arising in relation to Section 110 structures avoiding tax. So Sections 28 and 29 of the 20 of this bill on rights and IRFs, they do seem very small positive steps to making these entities contribute a bit more fairly to the Exchequer, although the changes in the 2019 bill for both rights and IRFs again seem to only yield 80 million in a full year. Rights will also be subject to tax, of course, where they claim deductions for payments which are not wholly linked to the property rental business. As indicated, I think in Budget 2020, IRFs are supposed to be subject to tax at 20% on certain deemed income. And I presume further details on rights and IRFs tax returns and compliance measures will be available to us at the committee stage. Section 60, which inserts a new Section 31D into the Principal Act, also seems an important, useful anti-avoidance measure, since stamp duty of 1% will apply where court-approved schemes of arrangements are used in acquiring Irish companies, including rights. But given the increasing shift to private renting, sponsored by this Fianna Fáil government, this finance bill, like every finance bill since the state was formed, clearly shows these two political parties relentlessly working on the side of massive property and developer industry, which are such powerful allies in the media and across the professional classes. And Cancorla, will the day ever come? Will the day ever come when supernormal profits from this grotesque property industry will be clearly and fairly taxed in an Irish finance bill? Part 6, of course, of the bill in Section 66 introduced new Chapter 3A, implementing the mandatory automatic exchange of information in relation to reportable cross-border arrangements. And the new Clause 3A inserts, of course, EU Directive 2018-822 of May 2018, amending Directive 2011-16/EU into the Irish Tax Code. Now, this also seems a welcome development, Cancorla, to the Principal Act, and, of course, EU Directive 2019-22 is colloquially known as DAC 6. And imposes new obligations on intermediaries or taxpayers who enter into certain cross-border arrangements. And of course it facilitates the exchange of information between the tax authorities across the European Union. And the intention, of course, is to detect and hopefully deter aggressive tax planning and tax avoidance within an EU cross-border context. But again, perhaps the Minister will expand on this, on the role of intermediaries and hallmarks at committee stage. Actually, one point I just want to mention, which I mentioned earlier at the Budget Committee, is that most legislation which comes in here Deputies get a full and detailed briefing, background briefing, in relation to the legislation, but the only one where we don't seem to get that briefing, either from the Library or so far from the Parliamentary Budget Office, is on the Finance Bill, which is a 120-page document. Perhaps that's something that the Ceann Comhairle, when he gets a chance, could take up on our behalf. Taoiseach Varadkar, of course, continually held out the prospect of tax improvements for ordinary taxpayers during the run into Budget 2020. Of course, tax bans and credits are almost completely frozen in Budget 2020 and this finance bill. The increase, of course, in the home care credit to €1,600 in Section 3 and the earned income credit to €1,500 in Section 4 are very welcome, as is the one-year extension of the reduced rate of USC to medical card holders. But the other Chapter 4 income tax improvements, including the training allowance payments, other education-related payments and certain pension reliefs, are also welcome. But in general, relief for income taxpayers on lower and middle incomes are totally lacking in this finance bill. This reality, of course, clearly shows the government's intention to make ordinary taxpayers and social protection recipients pay for Brexit uncertainty and the Brexit crisis, and for the climate action remedial measures, despite all the talk about dividends from hypothecated taxes and so on and so forth. No word of it in this bill, Ceann Comhairle. As report after report of the Irish Fiscal Advisory Council has urged, net policy spending can be significantly increased in desperately needed areas like health and social housing. But this Fine Gael Fianna Fáil regime has resolutely set its face against measures like significant taxation of the property industry. In my own budget submission to the Minister, I advocated, for example, an increase in the vacant site levy to 25% to deter land hoarding by developers, which would realise over €100 million a year. And I also advocated a 43% tax rate on earnings above €100,000 per annum, which would bring in nearly €400 million to the Exchequer. A fortnight ago, the well-known economist, Mr David McWilliams, he cogently explained in the Irish Times that, and I quote, "taxing the ultra-wealthy makes economic sense," end quote. Mr McWilliams referred to estimates and data on the wealthiest cohort of Irish society. Both the European Central Bank's Household Finance and Consumption Survey, the HFCS, and the Credit Suisse Bank give revealing insights into wealth in this country. The European Central Bank's HFCS shows that the top 5% of the Irish population owned almost 38% of all Irish wealth, and the top 1% owned an extraordinary 27%. And that would include, of course, it would include land and all other valuable assets and stocks and shares and so on. Mr McWilliams reports that a sliding wealth tax of between 0.5% and 5% on the top 1% or 5% of the population would yield a minimum of €2 billion. That would be, if you put 0.5% on the top 1%, up to an incredible €20 billion if you put 5% on the top 5% of the population, who controls over a quarter of our wealth for the Exchequer. We had that discussion, I think, several times at the Budget Committee with the Irish Fiscal Advisory Council, with the Minister himself. There are resources. It is coming to a time, astonishingly, by the way, Ceann Comhairle, in countries even like the United States, where legislators are beginning to think seriously about returning to the kind of wealth tax regimes, high-income regimes that we had down to the Thatcherite Reagan period, where the wealthiest in society, those who can most bear the cost of providing a decent, humane health system and providing housing for all those who need it and providing public transport, those people who have those resources can make a bigger contribution. But it has to be said, of course, such a wealth tax would truly broaden the tax base, but there will be never such an initiative in a budget or finance bill in this country until we remove both Fine Gael and Fianna Fáil from the leadership of Irish governments. Thanks, Ceann.